In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon. Once again, Market Rebels, it's that time again. But actually, Stu, it's not that time again. We're not hearing the closing bell.
No, it's not that time yet. It's actually,
we got dragged out of bed at 9 a.m. to record this early for everyone. Yeah. Normally we do this live, but today's a little different. We have a very special meeting. We're not even sure what it is, but we got called to it. Yeah. And that's just happens to be when we're going to be doing or would be doing Coach's Corner. So yes. I wanted to bring that up because we will later be bringing up a live platform. And many of you are going to be saying, hey, wait a minute, that's not what it looks like at the close. And you're right, because right now the markets aren't even open. But they'll probably open during while we're talking here. So you'll see
it's
that.
Like 9 o'clock in the morning right now. So you'll see this at 4, but it's actually 9 o'clock. The same.
Exactly. So just be aware, if the candlesticks look a little off in the prices, that's why. But let's go ahead and get started. So here's our Chalk Talk question. Stu, now I know, listen, going to fully admit this is very subjective, but it's to make a point. So what's the most powerful candlestick pattern?
Well, look, if you wanted to, here's the real answer, Bill. Real answer is everybody, like you said, has an opinion. If you line up 100 people, you might get 100 different answers.
And you will.
Right. I kind of have an idea what you're going to say. I'm sort of on board with that. You want me to answer it? Or
No. We're going to hold off on that. But I just want people to think about it.
Yeah.
So what we're trying to get you to see is that it's really conditional on two things. And we'll talk about that.
Yeah.
But unfortunately, a lot of people don't do that. They just say, oh, we've got an engulfing pattern or a doji, and therefore it's powerful. You need to dig a little deeper. And that's what we're going to talk about here. So for today, Stu, we are talking about the 5 key major moving averages.
Excellent. Love it.
Yep. So these are things we
trade without it. I don't think you could trade without it.
It'd be very difficult.
Yeah, it helps best, and it would be hard. So.
Yeah, we're going to show you what they are. They work in any time frame. So even if you're short term, they will still work. Stu and I mostly focus on longer term on the investing side for Q&A, but take your pick. These are really 5 that you should know.
Intraday also.
They absolutely work fine on intraday.
Moving averages, 15-minute bars. Yeah, excellent. Yep.
So let's first of all do a little kind of a detour here and talk briefly what are moving averages, how they work, some of the characteristics, and then we're going to bring up a live platform. So a moving average, it is a technical indicator used to smooth out prices. That's the primary reason for using a moving average. They're used in all fields that use charts, right? So even if you look at a lot of economic data, they will almost always, I'll even go out on a lim and say they always use some type of moving average because it's very hard when you get all of the zigs and zags to try to see the trend. And so that's the main reason for using them. So it's easier to see trends It is also important to remember it is a lagging indicator, as most indicators are, because you're
Yeah.
using past prices.
Yeah.
But that doesn't make them unusable. They can still be very powerful. And that's what we want to help to show all of you better ways to use them.
I'm going to point out the obvious here.
Okay.
It's it's why they call it a moving average. It moves.
We're going to talk about that. We're going to talk about where it comes from.
It moves day to day, intraday, minute, 5 minute bars. They move. They have
right.
angles, they have slopes, and they change. They're changing all the time. They are moving average. They are averages and they are moving.
Yep.
If you're using a moving average from day to day or week to week, understand that there could be, and there most times will be, an angle to it, and that like next week it's probably not going to look like it looks today.
Oh, very true, especially if they're very short term.
Yeah.
So before we get going, quick reminder for everybody, especially if you're new to options, please check out marketrebellion.com/get started. We have a lot of great tutorials, videos, articles on there to help you get a firm foundation with your options trading careers. So let's talk a little bit about the construction, kind of what you were alluding to there, Stu. Let's say that we have a 50-day moving average. What we're going to do is we are always looking at a 50-day window. So if we were to construct one by hand, we would take whatever our time frame is. Let's say we're looking at a 1-year chart. We're going to look at days 1 through 50.
Mm-hmm.
And then we're going to take the average. We're just going to add up all of those closing prices and divide by 50.
Yes, we are.
And then that's going to give us 1 point on the chart on day number 50. And so the current price might be 100, but the average might be 95. So we would get a dot at 95 right there on day 50.
Yeah.
Then we're going to
average. It's just what it says. It's not a mystery. It's an average of those 50 days. So Bill, what happens on day 51?
On day 51, we're going to drop off day 1, and we're going to look at days 2 through 51.
Yeah.
And we're still a block of
average. It's
still a block of 50 days. We add them all up. Yep. So we drop off the oldest piece of data and we add the newest. Now, is that going to increase the average or decrease it? Well, it depends. That's kind of the beauty of it. It depends on what's happening on average. So that's really all we're going to do. Then we're going to use days, as you said, 2 through 51. Then we're going to use 3 through 52. But it's always a 50-day window.
Bill, if I could answer that question right there, I'd probably be out on my 150-foot azimuth yacht.
You absolutely would be
somewhere, right?
Especially over a 50-day period, right?
Yeah.
It would be extremely powerful. Now, there are other ones that are exponential moving averages, and I think a lot of people like to use them because they like the word exponential and it's faster. It just uses a little bit of a smoothing technique. It gives more weight to the recent data. A little bit, but it doesn't make a whole lot of difference.
It's not a material effect.
Not a material effect. Might be better for super short-term traders, intraday traders. But the other thing is you have to realize it's not a true average. And there's some things that we'd like to see with the averages. And that's one of the reasons I tend to stick with a simple moving average. So
I do as well. And one of the reasons why I like that, aside from what you just said, Bill, is that I kind of like to look at what everybody else or what the majority of people that are
That's
looking
correct.
Yep, and I think in the big bad world that we live in, the majority of people are actually just looking at a simple moving average.
Right. And again, it's not really going to change your decisions materially. So let's look at some of the properties. One thing you'll notice when we pull up a live chart, shorter moving averages are more responsive. So whether you're using a 20 and a 50 and 100, 100, 200, 500, the shortest one will always have more waves in it than the longer ones. Longer ones tend to look more straight across your platform. But the shorter it is, the more responsive it is. And that's because it is dropping off the older data first and picking up the newer data.
Yeah, faster.
But it will also show more signs of volatility. So that's kind of a quick way. If somebody's looking at a chart and they've got a 50 and a 100-day moving average on their chart, you shouldn't look at it and say, which one's the 50? You should be able to look at it. The one with more waves on it, or the one that turns up first or turns down first, is the shorter one. So we'll see that as well. So they're the first to turn up and the first to turn down. So again, longer moving averages are less responsive, and so they appear smoother. Now, another property is, and I think most traders know this, you can think of them as a magnet.
So if stock prices are above your moving average, whichever one it is, the more they get stretched away from it, there is a tendency for it to come back down. It's just really mean reversion back to the mean. This is the mean. It's the average. So there's a tendency for it to come back towards this average. If stock prices are below, there's a tendency for it to get pulled back up. And the further prices are away from the moving average, the stronger the effect. And so sometimes you'll hear people call this the rubber band theory,
I
or
was just going to say that. Yeah.
the rubber band effect.
Right. You could be reading about something like this, and it would be it would be termed the rubber band effect. Yep.
Yeah. So you can think of it as if you think of your moving average and the current candlestick, and it's tied to a rubber band. And so the further that price moves away, the more it stretches, the more the tendency is to get snapped back to that moving average.
Yep.
Right. So we'll see that in action as well. One more quick little blurb, marketrebellion.com/get started. Please visit us there. Lots of great stuff, and it is free. Okay, you can't beat the price, so please check us out there.
Free is for me.
It works for me. So now, Stu,
Yeah.
here's the thing that most people don't know. The 5 key major moving averages are the 50, 100, 200, 500, and 1,000. Now, I know there's going to be people who'll say, well, what about the 150? What about the 20? What about the 9 and the 12? Those are far more shorter. Actually, those are definitely shorter term. And if you're trying to do day trades, you probably don't want to be using these, or at a minimum would want to be including things like a 9 and a 12 and a 26 and some of the things that MACD and RSI use.
And the crossovers.
And the crossovers, right. But for the most part, for your longer term decisions, and remember, that's where the big money is.
That's where the wealth is. Yep.
If you're on the hunt for the big elephants, these are the guys to watch.
Which takes time. Let's throw that in there.
Exactly. It does.
Compounding,
Yep.
the whole business. Yep.
Yep. So we're going to see that in action. Trend spotting, another use of moving averages. When the moving averages run parallel to each other, they'll look almost like railroad tracks running side by side. That happens during well-defined uptrends, long-term trends, and they will also appear in numerical order. So no matter which numbers you have, but in my example, you'll see the 50 on top, 100, 200, 500, 1,000. There won't be any crossings. They'll just be running in kind of a parallel fashion.
And we have some of that going on right now.
Oh, we totally do.
This market's been in a long-term uptrend, and that what Bill's saying is,
Yep.
if you see that going on, you can define that as a real strong long-term trend. To do what with? Well, keep an eye on when it breaks, if it breaks.
Yep.
Well, really, when it breaks.
Yeah, very good. When it breaks, not
When it
if.
breaks, yeah.
Always expect it. That might be a time to use, let's say, covered calls. I know a lot of times people like to use them in sideways markets, but that's usually when the stock is about to break up or down, neither of which is ideal for a covered call. Breaking up isn't really the worst thing, but it's not the best thing either. But if you are in a well-defined uptrend, that's kind of a good time for covered calls. So there's a lot of reasons why we would look at these. So if the moving averages are running parallel to each other, a strong trend is intact. If you get a series of crosses, then it's a sideways trend. It's really hard to get any kind of a read on it. So some basic signals.
And that doesn't mean, by the way, in our world, Bill, that doesn't mean that you can't make any money trading.
Oh, God, of course not.
Options. It just means it's just a way for you to kind of, indicate or see for yourself that that's what's going on. And then you develop strategies around that.
Right. So let's look at some basic signals. If the stock price is moving below the moving average, there's a tendency for it to continue lower. And there's a reason for that. What you're saying is that the current prices, right, if the current prices are below the average, let's say it's a 50-day moving average, what does that tell you mathematically? The current prices are doing worse than they have on average over the last 50 days. You could make a good argument that something has changed. We've fallen below average. If the stock price is moving above the moving average, so from below to above, there's a tendency for it to continue higher. Something has changed. And it doesn't necessarily mean it's a piece of news. It could just be sentiment that people suddenly think that something has changed and it's now time to buy.
Could be more to sell than there is to buy, or more to buy than there is to sell.
Correct.
And one of the things that people need to kind of like ask themselves, like at least in my opinion, which may be worth nothing to whomever is watching, but what I think is that you have to discern in times of especially in times of market distress, COVID, the financial crisis of 08, things when like big things are happening on the downside of the market. You really have to ask yourself, is the company that I'm looking at, is it part of the overall trend of the market getting crushed, or is there really something wrong with the company?
Right.
And that can help you to decide do I really want to be investing in this company at what appears to be a discounted price? Maybe the discounted price is not really a discounted price, even though it's lower than moving averages. Maybe there's something wrong with the company. Maybe it's actually really high. But this is the kind of stuff that you have to ask yourself and it's kind of difficult in today's world because everything is just tied in with one another. There's like this little string that goes through everything these days, and you yank on and you kind of feel it up here. So, but it is a question that we should always ask ourselves. Is it the correlation of the market to the stock that's bringing it up or down, or is it the sector, or is it the company, or, what is it? A combination? And it's just a question that I think is a good one to ask yourself.
Absolutely. So again, the main thing to look at here is that something has changed in the trend. And that's one of the things that the moving average can show us. So one of the ways that we do that, another technical signal, is moving average crossings. So if a shorter term moving average crosses a longer term, whether it's the 50 crossing the 100, the 50 crossing the 200, whatever, the stock price is trending higher. Now, again, remember, these are lagging. Now, I'm not the biggest fan of using these for signals, but it can be a nice confirmation. If you're thinking that, we're getting near a top, but you're seeing one of these cross, it might be a signal to say, maybe let's hedge it, but let's stay in.
And people may read this or see this, and you're thinking golden cross, and that's the idea here. That's the idea.
It's the basic idea, right?
Through the longer term.
Yeah, but I would be very careful about using that for an entry signal. I think it's more of a confirmation signal. But again, what it shows is that recent prices are higher than in the past on average. Mm-hmm. And if a short-term moving average crosses the long-term from above, stock price is trending lower.
Death cross.
Okay. Recent prices are lower than they have been in the past. So moving averages can be used by themselves, kind of the ways that I talked about, but they are really powerful to overlay with other indicators. And I think that's where most people misinterpret them or aren't using them to their fullest benefit.
Yeah. So have a checklist of indicators that you're using. The moving averages are helping you to describe the trends of the candlesticks, but have a couple other indicators as well to put on your checklist to help confirm one and another.
Yep. So unlike a lot of the coaches' corners where we save the answer for Chalk Talk at the end, I'm going to do it here while I've got the slides up. It will also help to confirm what we're about to show on a live platform. So what's the most powerful candlestick pattern? Now, again, I know people are going to be saying, that's not really true. It's subjective, and I get that. But my point was, pick your indicator, whatever it may be. But if it coincides with a major moving average, and you're going to see that, that's when the stocks tend to go on the biggest, most aggressive, most extended runs.
And Bill's not making that up, everyone.
You're going to see it.
Go back and you could document that for as far back as, this has been going on. And that is really true.
Yep, absolutely. So that is our answer. Now let's bring up a platform and let's put it to the test here, Stu. Okay. I'm actually going to bring, let's bring up the plots over here. All right. So there's our, now on my platform, you should see, it's a little hard to see because it's been in such a good uptrend, but you see these kind of waves in the red, a little wavier than the orange. But the orange is a little more waves than the yellow. Green is almost straight. The purple down to the pink is kind of all even straighter. And they are the 50, 100, 200, 500,000. Now take a look that they are also running roughly parallel to each other.
Roughly, and nothing exact.
Exactly. Don't get out the protractors and say, they got a little bit of a pinch. No, we're just saying roughly that there's no crossings like there were back over here. So notice that the 50-day in red finally crossed above the orange in mid-December. And so we've really been, in stock market terms, a relatively short time in a well-developed uptrend. right? Because we've got these finally starting to fan out. Now, let's take a look at the moving average pattern. This is kind of part B to this presentation. Whenever candlesticks are above, there's a tendency for it to get pulled down. If it does, it acts as support. Even if it's just for a day, you are most likely going to rest. We can see on that one candle right there, paused. If you break, there's a tendency to do what? Go to the next one in line. And we can see we came right down here to the orange, which is the 100.
And Bill, let's just take a moment and reiterate for the 5,000th time. These are while these are finite numbers on the average, it doesn't mean that a stock or an index like this, an ETF, is going to absolutely hit that number.
Of course not.
Right? Or we're just looking for areas. Where do we think it's going to go?
Right.
If we on a break, we kind of think it might go to the area of the next one. That's the idea here, people.
Right. So I often say it's not a finely sharpened pencil like it looks on your platform. Ron used to say, think of it like a broad-tipped magic marker or a paintbrush. You're just looking. So, don't say, well, this candle didn't actually touch the 100. That's still a touch. It's just somewhere in this area. Now, part of the theory behind that is that if everybody's expecting it to bounce off of here, what would you do? Well, you might start buying.
That's right. See, that's what develops in our world called the trading line. And the trading line is going to be a little bit higher. And that's people trying to jump in above.
People are going to start anticipating that. So that could be a reason why you don't quite get there.
Yeah.
But now look what happens. On the way up, what's the rule? It's probably going to act as resistance. And look at this. And it's a doji. Now, here's a good example. It's a very short term, but it's a doji off of a major moving average.
Powerful.
And we did resist, came right back down to the 100. On the way back up, doji, right on the major moving average. Mm-hmm. Then we get our 2-candle break. Now, a 2-candle break is just what it sounds like. The second candle, I would prefer to take the second green candle. I would consider in this case, like this red one, as long as it's higher highs and higher lows, which it was in this case. But if you want to be sure, wait for a second green. But we don't want to jump the gun and do the first candle, because sometimes you'll see what are called false breakouts.
This could be part of like a slicing in approach.
Oh, yeah. Beautiful.
Don't take the whole thing here, right?
Correct.
On that red candle right there. Do a little bit. Just kind of get your feet wet, get started. So if it does continue to go, you're not out, and not being all in on the way up is not really a bad problem to have.
Power of scaling. And if you do take part of your position here and it does come back down here and you take part B here, your average is right here. You're not too far off.
And what's the other side of that coin, Bill, right? If you took a little bit and it goes down and you lost, well, if you took the other side of that is if you took it all up there, then you have nothing left to be.
You'd have a bigger, right? Exactly right. Yeah, and now you panic. Below. Right. If it's part of your goal is to say, I'm going to just take little nibbles, then that's fine.
Yeah.
But these are some good areas, especially for longer term. Now, look what happens. We get stretched away. What's the rule? Probably going to come back. And where would we expect support? Off of the 50-day moving average. Wow. What happened? We're either going to fail. If we fail, we would expect to come back to the orange, or we're going to bounce. In this case, we bounced. So this pattern is persistent. Now, to show this, let's go back in time.
And if you take a look at the higher highs and higher lows, or in this case, higher highs and higher lows, and in this case right here, what Bill's looking at in the middle of the screen are lower lows and lower highs. You put the lines together and you draw what we call, like I think Bill, you said it before, you draw railroad tracks, and now you have what's called a channel. That's what a channel is.
Exactly.
Right, and that's the oscillation of the stock in the midst of a channel. So it doesn't go straight up all the time. It doesn't go straight down all the time. It's just an oscillation, and it's there's a lot of indicators that are called oscillators, and this is what it is right here.
Yep. So let's take
defined by the borders called the moving averages.
Exactly. So let's take a look at this one here. Let's start back here. We can see we got stretched away from the red. Now notice the red is below the 500. This is the 500 in green. And it doesn't matter which order they're in. That's important. It's always whichever one is next. So on the way up, we would expect it to resist here. If we don't go through it, probably going to come back to the next one, which happens to be the 50. Come back up, expect to resist. Here we got a doji. It's actually called a gravestone doji off of a major moving average. Very powerful. and come down here. What is this down here, Stu? This is a classic kicker pattern, but it's not just any kicker pattern. This is part of what the Chalk Talk was about. It's off of a major moving average.
Right. Really
These
strong,
are the ones.
right?
Yep.
Really strong. Is that the answer to your question? Is that your answer to your question?
Yes, if it occurs off of a major moving average.
Yeah,
Now, for me,
right.
I think the kicker is probably the strongest of them. But take your pick. It could be an engulfing pattern. It could be a doji. Could be a piercing pattern, meeting lines. There's all kinds of them.
Yeah, you can get a couple there's plenty of 2 candle patterns as well, like Bill just said.
Yeah.
Meeting, right? And where do they fall? Well, again, it's subjective, right? The kicker patterns are really strong. That's the point, right? Engulfing patterns are really strong. I mean, these are things that you can look at. You have to know the names of every single candle pattern out there? No. Just look at the story that's being told to you by the formation of the price action, which are the candles.
Yep. So on the way back up, now this should tell you this would be a really good place to take a position, whether you're taking shares, stock replacement. I will always take stock replacement off of the 200 or lower, 200, 500, and 1,000. But right here, it's off the 50. But look what happens. Came back up, resisted, came back down, supported, resisted for a day or two, bang, 2 candle break. What does that tell us? Probably going to be set for a very long extended run. Got a classic doji up here. Came back down, supported for a day, technical fail, 2 candles.
Look at that engulfing pattern up at the top.
I know. It can't get much more classic than I know.
Oh my God.
So now when we broke, we would expect to go to the next one. Did we come all the way down to the orange? No, but it's still an area to watch.
Mm-hmm.
On the way back up, what's the expectation? Probably going to resist. Where did this red candle close? Right on the 50. Came back up, 2 candle break. Now here's a case. We got a 2 candle break and came back down, broke, came back up. It wasn't a real strong one. Those are going to happen.
Yeah,
That's
you can
called
almost
risk.
call that a false breakout right there.
You could almost call it a false breakout.
But if you take a look at what happened, moving forward, it's a lower high, right? And that's
and that's true too.
Right.
Yep.
And then you got the lower low, the higher low, and that's what's called the triangle pattern. And as you move into apexes of triangles, you tend to get these explosions, and just something else to look for.
So now here's a good example of what we might call a false breakout. This is why you don't want to jump on that first candle. Give it a second one. In this case, kicker pattern off of a major moving average. Came downside. Right back to the 100. Mm-hmm. But what happened now? We failed the 100.
Right.
What's the next one in line? In this case, we have 2 of them, which are the 200 and 500. And if you have more than
better than one, right?
If you have more than one, it becomes, I usually call it double strength or triple strength. And look at this, support right off of there.
Yeah.
One of 2 things are going to happen. We're either going to break, in which case we would expect down here at the next one, which would be 1,000, or we're going to bounce, which would be a resistance at the next. Now, again, we've got a double. That's going to be a very strong resistance. Failed, came back down to the yellow, failed, came down to the green just for a day. Now, you and I always say if they're this close, we take the one furthest away. We'd look at the green as being the support. Here's another example where it didn't quite work. We might call this kind of a false breakdown. But what do we see here? Even if you took a nibble down here, what do you see here? A kicker off of the 500-day. That is an incredibly powerful signal. These are the ones you've got to take. And look at this. Got this nice.
And even if you didn't take a nibble down there.
Right, exactly. Right. If you just took this one. So what?
Who cares? It doesn't really matter, right? Yep. Don't try and pick the bottom based on any of this stuff. Never, ever, ever try and pick nor the top.
Exactly.
It's just not going to work.
Now, some people wonder why we look at the 1,000, and here's a good reason. It does come into play. Now, keep in mind, that's basically 4 years of trading data, but it does come into play. Sure. So if we look at this was late 2022, came right down to the 1,000, got a kicker pattern off of the 1,000. Long term, your best buying opportunity right there of the year. All right. Now, are there zigs and zags along the way? Of course, but that's what markets are about. So let's go back to.
So let's take a look at that for 1 second. That. Yeah. Okay. So I'm going to play devil's advocate here. Well, that's easy to say because now you can see that it went up. So of course it was a great buying opportunity. Mm-hmm. So now you got to put yourself back in time, right? Just transform yourself in the time machine and go back in time, like Back to the Future, and say, well, I'm here now. What can I do? And now you go back to your discipline, your trading discipline, and say, hey, I'm off a major moving average here. Maybe I should do something.
Something.
And then all of a sudden, as time goes on and you look back and say, hey, I'm the smartest guy ever. Really? Not really. You just took a position off a major moving average. That's it.
Right.
It's in every classic textbook there is.
And that's a great point, because when you're in it, you're going to be scared to death, because you came from this. This is what you're seeing on your computer screen.
Yeah.
But as Stu said, this is your discipline. You've got to say, if you're going to be a long-term investor, you are here to take risk, but this is a great opportunity and you need to take it.
Yeah, by the way, that's why you're getting paid more than a risk-free rate.
That's right. If you want the risk-free, take T-bills. Exactly.
There you go.
So here is COVID. Now, I'm going to come back to that in a moment. Now, here's fourth quarter of 2018 for people who remember. There was a lot of screaming about the earnings going into the
Christmas Eve season and stuff. Night was
and look at this. Brutal. And here we got not quite a kicker, but but it is definitely a two candle pattern. You certainly got a kicker off of here, but right off of the 1,000-day moving average. And if we look over the long term, very big run. If you're doing stock replacement, which remember by definition has very little extrinsic value, all of these pullbacks meant zero, meant absolutely nothing. You could have rolled through here, added through here, doesn't matter. This is making a ton of money through here.
And Bill, these are daily candles. Am I correct?
And these are daily.
Yeah, right.
Hold that thought.
Okay.
I know where you're going. That's why I said I want to come back here to COVID. Now, COVID, we come in here and you're looking at your 5 key major moving averages. See, we were in a nice uptrend going into COVID, right? And then what happened? Look how quickly that 50 crossed through. There's a good example where it's far more responsive. You can see the 500 barely moved. The 1,000 didn't move. The 200 didn't move. So this was really a short term. Yeah, it was so quick. And as a trend, and listen, I went through this. I took a buy in every single green candle on the left side and every single green candle on the right. And it was terrifying. But I kept looking. I thought, you know what? Over the last 200 days, we haven't really budged on average. That's the key. Yes, it's a very fast and furious dip. But the point is, if you're looking at this going, hey, wait a minute, we've busted through all of our moving averages. What do I do now? Now, here we see, look at this kicker pattern down here. That should have been a clue. But what we do now, what we teach people is to go to a different candle time frame. Each of these candles is a day. Now I'm going to switch to a weekly candle. So what we're going to see now is the 50-week average, the 100-week average, and so on. And so that just rescales. Lovely. It's going to take me back. If we can get our moving averages on here. Sorry about that. One of the things that just drives me out of my mind on this platform. There we go. So now we see into COVID, we're looking really close to the 500. I'm on high alert. And what do I see in the weekly? Engulfing pattern off of a major moving average, or at least close enough. How do I know it's close enough? Because look at the size of that candle. Something flipped here. And so I can also go back and see that it's if we go back to the
now let's be honest with everyone, Bill. We don't really know.
No.
We don't know anything. But what we can see is we have a strong candle pattern.
We have
with a major moving average just below us. That's correct. What we do know.
That's what we do know. And so we got this very strong uptrend. Look at it even in a weekly pattern. I said they work in all time frames. We come back, support, came back up, support, broke, 2 candle. That's our technical fail of the 50.
Up and down.
Come down to the orange.
Down, just
for a day or two.
Moving average.
Just maybe for a day, you would expect one of 2 things, either going to bounce or break. We broke, came back basically to the 200.
So there's your 2 candle. There's your 2 candle. Wait for a 2 candle confirmation. See, it didn't happen.
Well, and that's true too. Yep, good point.
It didn't happen right there.
Would have kept you
kind of patient and sat on your hands waiting for a 2 candle, at least a 2 candle break. It didn't happen. That kept you out of trouble. Sometimes no trade is the best trade.
Oh yeah, I say that exactly right. Up here, Okay, we're going to take the furthest one away because they're fairly close. There is a bearish harami off of a major moving average. Look at that.
What can
that
you do
shadow.
there as a position management? You can lean into some extra deltas, and and if
Oh,
you're
yeah.
doing
Yep.
2-to-1 ratio, maybe you do maybe you sell an extra one. Maybe you
Exactly.
sell an at the money or instead of an out of money. Maybe you sell in the money instead of at the money. Maybe you scale. You just scale a little bit different, and you take a little bit less delta, because what you're looking for is the stock to retrace. And that would be going down, and you want to have less long deltas, and that's being a trader
Right.
inside the umbrella of being an investment person.
Well said. Right.
Which
Nobody
is,
says.
sometimes that's hard to do, but that's
It
what
is.
we're talking about here.
But we can see that once we broke, came right down to the major moving average. In this case, the 200 on the way up, resisted. On the way back down, basically support, resist. Once we got our break here, most likely going to go on the longest extended run. Good support down here off of these major moving averages.
And look at that trend. My eyes can see this trend.
Oh, yeah.
The top band of the lower highs, the top band right in the middle of the screen, the top band of the lower highs, just draw that line, and then the line breaks. And that's indicating to you that when you put it next to the band on the bottom, which is beginning to have higher lows, right now the trend is shifting to the
It's
upside.
shifting.
look
And
what
we also see the 50 has broken up from below. That tells you,
confirmation.
on average, the last 50 days have done better than on average over the last 100 days. Something has changed.
Bill said that before, right? You can use those crossovers as confirmation, right?
As confirmation, right. But you can see by the time it crossed here, the thing's long gone. But what I would look at is, let's say, as you're here, you might be thinking, well, we've had this nice little rally, but you look and say, but you know what? We're just actually crossing into a stronger uptrend. Maybe we should
Technically,
hold.
that's a real strong area. You're bouncing off
A very strong area.
averages, and you have the crossover. Technically, you could say you can justify to yourself to take an additional long delta position right there.
Exactly.
Right there, off a 2-candle upside confirmation.
Yep. So what we'd like to recommend is for all of you who are watching, go back, take your pick. We're not cherry picking these. So just to do that, Stu, I think we got maybe a couple of minutes. Give me another ticker here other than SPY.
I don't know. Everybody likes to look at Apple, right? Everybody has Apple, so let's look at Apple. How's that one?
We do like Apple. Now, Apple had big gaps here, but let's go back to here.
Yeah, don't even
We
think
gotta-
about the last couple of days. We all know what happened there. Just
Two
look
candle-
at the big picture.
2-candle break, most likely going to be your biggest extended run. Now, this case, we didn't even come down and support. We shot straight through it, but where did we support?
It happens.
Next one in line at the 100. On the way up, resist off of the kind of a false breakout here at the 100. Failed. Where do we go? Next one in line. On the way up, resist. Next one in line. Fail. Next one in line. 2-candle break. Nice little run. Failed. Next one in line. You can kind of see came down right here to the 500. Big break here of 3 major moving averages on that gap. That's something big. That is almost always going to be probably an earnings or some kind of major news to see when you shoot through 3 moving averages like that. But let's go through, let's go see what they did in fourth quarter of 2018. What happened? Right off the 1,000.
That is unbelievable.
Yep.
Unbelievable.
So, and look at this, right off the 500, biggest runs off of here. 200s.
So let's go back and restate what we said before. Go back to that. Right there. Right. That's right on the 1,000 right there. So now you're back in it. Right. You're in the mud. You're sinking. You're drowning. What do? You get your wits about you. You try your best to remove the emotion. You say, I'm in the neighborhood of this major moving average. I'm getting a little bit of it's kind of hard to see. It looks like a little bit of a kicker, maybe a touch.
It is a kicker pattern. Yep.
Right in there. Hey, my discipline's telling me that this is technically a decent place to be taking a long position. Let me start getting my feet wet.
Yep. So for people who might not be familiar with that, a kicker pattern, a bull kicker occurs after a long downtrend. We have a red candle. The next candle is green, but do you see how the entire candle is shifted higher? At a minimum, that it should match the opening price of the red. The two opening prices should match. That's the bare minimum definition for a kicker. But if you get a gap between them, it's just that much stronger. And an engulfing pattern has the same idea. It's just that it gaps down first and reverses during the day. This reversed right off the opening bell, which is why I think it's a little stronger. But that is absolutely a kicker pattern right off of a major moving average. And in this case, deeper into the pits, the 1,000. And what does that tell you? Probably going to be a pretty good time to take some positions. And what do we see? Nice big long runs through here.
And what price was that? Like 42?
Like 40 bucks. Yeah, something. Unbelievable. Yep.
That's the wealth effect of how
exactly
this looks,
right.
I mean, unbelievable.
Yep. So anyway, we hope that gives you some good information. As always, we like to bring you some trading tips and tricks every once in a while, mostly focus on options and strategies, but they can be super powerful when you understand your technicals and your candlesticks, some of your oscillators, and you bring them together. So again, to emphasize the answer to our question, take your pick. You want to say a kicker's the strongest, a doji's the strongest, fine. But when it occurs off of one of these 5 key moving averages, which ones?
That's the point.
50, 100, 200, 500, and 1,000. If you don't have them on your charts, get them on there. You can see right here. Look at this, right down to the 500. I always say deeper into the pocket right there. I always take at least a 200. Definitely will take a 500 and 1,000. They don't occur that often, but when they do, they are unbelievable. Most of the time, going to be your unbelievable buys. That's part of the discipline. So we hope that gives you some good things to think about. Stu, any closing comments or moving averages?
Make sure you get these on your charts, people.
Yeah.
It's super important, right? 50, 100, 200, 500, and 1,000. And many of you may be saying, well, you know what? I'm never going to use the 1,000. Number one, that's not true.
It's not true.
Number two, you should know where it is anyway. It's part of your discipline, right? Just know that it's there. So it's part of knowing the product, right? So you know, you have an idea. Can it be a target? Yeah, it's not going to be a target right now, but at some point it might be a target. It's just good for you to know. So it's just part of your homework, part of your prep work to kind of know where these moving averages are. You know, is this one getting stretched right now? Yeah, it is.
Oh yeah.
Keep going up? Yeah, it can. Right? We're gonna look for things to happen if and when it gets back down to that what is that, 180 something, 182?
Yeah, about 180 so two or
right?
so.
Those 3 moving averages, that'll be an area of support if it gets down there.
Very strong.
Well,
yep.
But that will be an area of support. And we will.
And that's not a time of panic. It's probably more of a time to add to your positions. This would be a time to fade the market. Instead, what do most people want to do? They want to buy more.
And that doesn't mean you have to sell your position. It just means you lighten up on the way, right? You lighten up some deltas. You roll. You know, if you're using options, you can roll options. You can
use that cash to buy. Yeah, and use that cash to buy back down here. That's part of your discipline. Exactly.
Yeah.
So anyway.
Plan the trade and trade the plan.
Love it. Know your risk. And this is one of the ways it can help you to identify risks. So again, we hope that gave you some good things to think about. Sorry for not being actually live, but I guess we are live now.
Yeah.
But try it on your platforms. Do some homework. Pick your favorite stocks. Put those on and tell us what you think. We'd love to see you in Q&A as well. So with that, Stu, thanks for being here again. We got to get Scotty on next week. And I want to thank all of you for being here. And we'll look for you next week at 4 p.m. live. Next Thursday. We'll see you then.
Adios.